and a good day. First of all, can everybody hear me?
Yes, sir, I can hear you.
Okay, great.
Yeah, good at you.
Okay, how did we do on homework this week? I sent you, did y'all get all the stuff I sent? I sent, what I did send, just to rehash, was the prospectus on the government securities. I sent the C-File weekly summary. I sent the Royal Fidelity weekly summary. And then I sent you guys some practice problems. Did everybody receive them?
Yeah, I saw it.
Okay, and the homework was to do a comparison with government registered stock and salaried and workers savings plan. Did everybody do that?
Teacher, I can be honest, I did that,
Okay, so
but I will do it. But I didn't do it in time for homework, but I will do it.
no, it's it's part of your education and your awareness of how do you do financial comparisons. It's like, when you get the Thursday newspaper and you ladies, please, if I seem somewhat a Neanderthal man, I know ladies go in and look at what food stores have what special, who's selling grapes and everything. It's the same thing. Seriously, it's you get the best value of the
You
dollar.
ain't lie, you ain't lie.
Okay, it's the same principle you're applying when you go to shop around for financial investments. Okay?
I think I might need a little more help in this, at least the first class. I didn't get the full understanding. I got the understanding, but not the full. So I need more understanding in this topic.
Now, I'm glad you said that. I am trying to work out with Miguel that they fit in an extra class for me because they're trying to condense all of this stuff into 3 classes.
Yeah, that is a lot. I could have feel my brain cramping the last time.
And I am asking them to put on another class. Here's Miguel right now. Miguel.
Yes, my good folks. So Mr. Donathan wants you guys to have another class. So we're looking at February 3rd. That's a Wednesday because your module 5 starts on. You want to keep you on schedule. Your module 5 starts February 4th. So the first week in February, you'll have 2 classes, a Wednesday night and a Thursday night. Okay, are we good with that?
Okay.
I'm fine with that.
Okay, great. So the next class will be in for our last class. Your last class with Mr. Donathan will be February 3rd, Wednesday. But I'll send you the link and a reminder a few days before.
Okay, thank you, Miguel. Is that it? Is that it from your end?
Yes, that's it from my end.
Okay. Okay, guys. Did everybody get the homework, the sample problems I sent? That's number 1. Did everybody get it? Just tell me yes, you got it. I just don't want to know that I'm sending stuff.
We
out.
got it. Yeah,
Okay.
we got it.
Okay. Did you
Yeah,
have
we
a
got it.
chance?
Doing it.
Go ahead.
No, I said doing it is another. Who all did it was another question.
That's the next step. That's the next step because I'm trying to give you some things because we're going to be moving fast that in your spare time you can practice because this stuff comes with practice. So my next question was, in doing it, did anybody have a problem with it?
I had a problem.
Okay, let's hear it. Go ahead.
So I did up to number 5, and I was only able to get number 3 and 4 with the answer, what was on the answer sheet. But I couldn't get number 1, number 2, like with the present value and the future value. And I keep trying to figure out what I was doing wrong because I did it on the financial calculator and I also used the formula. So
Did you use, okay, well, 1, 2, and 3. Let's take a couple of these questions. Read problem 1 because I don't have it in front of me.
if you wish to accumulate 140,000 in 13 years, how much must you deposit today in an account that pays an annual interest rate of 14%?
Okay. Couple of things from that. First of all, what type of problem is it in your estimation?
It's a problem to find out the present value.
Okay, that's fine. What is the time frame that you're considering?
13 years,
Okay, what is the interest rate?
14%.
Great. So, and how often is interest paid?
I'm assuming once a year.
Why are you assuming that?
Mm,
I'm not saying you're wrong. What are you
no,
basing
I
it-
know. Because I don't see any information stating otherwise, like semi-annually or anything like that.
Okay, fair enough. So you're gonna find, is it a present value of an annuity or a present value of a lump sum?
Oh, that's what you mean. Present value of a lump sum.
Great. So you remember the tables I gave you?
I missed last class, so I probably, yeah, I know. I was trying to catch up.
No, not a problem. I have my financial calculator, but I'd like people to work it along with me. Okay.
I could work it along with you. I have my financial calculator.
Okay, so the interest rate is what, 14%?
14%.
All right. The period is how many years?
13 years.
13 years. And value you wanted to go to, what's the end value or the future value?
140,000.
Just working off of my calculator, I get 25,489. What does the book get?
I got 25,591 cents.
And what does the answer sheet say?
It says $25,489.71.
Okay, so I mean, there may be some rounding factors in it, but that's fine. Does anybody have the time value sheets, the interest factor sheets in front of them?
Yes, sir.
Okay, okay, let's do it from the interest factor sheets. Okay, let me pull them up first. Okay, present value of a lump sum. At 14% for 12 years, is it?
13 years.
13 years. I am
14%.
getting 14%. Okay. Whoever has the interest factor sheets, what is the interest factor that you're seeing?
0.182.
Okay, so how would you use that interest factor sheet? What would you do with that 0.182?
Multiply it by the 140,000 for me to get my for me to get my present value of the lump sum.
That's right. So when you do that, what do you get?
25,480.
Okay. I mean, what I was getting for 25,489, I figure if you see a multiple choice question, it's going to be one of these. It's going to be close. They're not going to get you to the exact dollar. But whomever the young lady was who was speaking, that you have the concept, right? I mean, you know how to do it. It's just that you may be off a couple of dollars. Is that what you're saying?
Well, yeah, essentially. Quick question though, the interest factor sheet you're talking about, was that something you emailed or?
Is this Patronel?
Patronel.
Patronel, you see, it don't be good to miss classes with me.
Mm-hmm.
You don't know what wealth of information I be giving up. But I still, didn't I send it on to everybody anyway?
You
I
send
got
it,
it.
you send email?
But you asked us for our email.
Okay,
Oh, that's right.
Patronel, give me your email address real quickly.
Okay, it's PATRANELLE
Yes?
Johnson@gmail.com.
Okay, I just sent it to you. Anybody else do not have those interest factor sheets? Please tell me. Good, I don't hear anything else. Okay, anybody else tried the problems and had a problem with it? You want to go through the first 5 of them? What's the second question?
What will 247,000 grow to be in 9 years if it is invested today in an account with an annual interest rate of 11%?
Anybody want to tackle that? Who read the question?
I did.
Okay, okay, Ms. McDonald, let's break it down in simple steps. First of all, in your mind, what type of question is this? Future value, future value of an annuity, present value of an annuity. What type of question are they asking here?
This would be the future value of, well, not of annuity, just the future value of a lump sum.
There you go. Okay. All right. Lead us through it then.
So what I'm using the table, I would go to the future value of the lump sum, find 9 periods at 11%. 11%. Which would be 2.558, and multiply that by the 247,000 to get an answer of 631,826.
Agreed. Anybody had a problem with that? You saw how she did it? Okay, now number 3 is a little tricky one. This is a little bit different. This one is asking for the years, and this one you're going to need a financial calculator. That one is a little tricky. How many years? So they're asking for N. Either you need a financial calculator or you will need to do it by the formula for this one. How many years will it take for 136,000 to grow to be 468,000 if it is invested in an account with an annual interest rate of 8%. Who has a financial calculator?
I have one.
You want to take a stab at that?
I
You can
actually
do it.
worked it out already.
Okay, all right, fine. You work it out.
I plugged it into the calculator, and I got exactly what the answer sheet had. So
Okay, what was, how long will it take to grow?
it'll take 16.06 years. I don't know if you round it off to 16 years. I guess in multiple choice, I guess whatever closer.
Uh-huh.
But I had the present value at 136,000. I entered the future value at 468,000. The interest at 8%, and that's how I got down.
And you just solved for N.
Right.
Great. Does everybody understand what she did? Okay.
Nope.
See, in working through these problems, and I ask you to do it, they give you a variety of problems. Like, take for instance, number 8, at what quoted annual interest rate must 134,000 be invested so that it will grow to 459,000 in 15 years? In 15 years if interest is compounded weekly. Oh, that's a nasty one. Anybody with a financial calculator want to take a shot at that?
So you don't have to use the table for that one?
No, you see, the table isn't for this one.
Okay. Okay.
You have to either use a financial calculator or do it the long way through the formula.
Okay.
Anyone want to take a shot at it?
I'm trying now if no one else not trying.
Is this Patronelle?
Yes.
Okay, Patronelle, lead us through what you're doing on the financial calculator. What is the first thing you're going to do?
Okay, so firstly, I'm just trying to read through it and write out, identify what the present value is, what the future value is.
Okay, let's read through it together. What interest rate was 134,000? What would you think the 134,000 is?
The present value.
You got it? Be invested so that it will grow to 459,000. So 459,000 is what?
The future value.
There you go. 15 years, N. Now, working out this N, be careful now, working out this N. How are you going to find N? In 15 years, if interest is compounded weekly.
So would I divide that by 52 weeks? No,
The opposite. You will multiply the 15 years by 52 weeks to find out how many week periods are in 15 years.
Okay, so that's 780.
That will be N, right?
Right.
And you just solve for I.
Right. So
I get 15.8%.
hold on, I got an error. I don't know what I did wrong.
Not a problem. Make sure you clear out all the things with your memory so you don't.
Okay. For some reason, I don't know why it keeps giving me an error.
Is this question 4?
8.
Eight.
I guess I could jump in.
Sure, Camille.
Okay. What I worked out, what Patronel did thus far, the N, 15 times 52 to give me 780. Future value is 459,000, and the present value is 134,000.
Right.
One thing, Passionel, maybe what you didn't do with the present value, you have to put negative.
Ah, yeah.
Yes.
Thank
yes.
you, Camille.
Mhm. And with that, for the interest, I got 0.158. And to find out for the years, I times that by 52 to get 8.216.
You are absolutely correct.
Mhm.
All right. So you guys got the gist of it. I'm going to leave you guys to do that. I need to push on and cover some more of this material unless there are additional questions.
I just had one question, sorry. Regarding, let's say, like questions 17 through 27, which I think we touched in class, but not really. I have a little bit of trouble with those. So I don't know, maybe
What
for
is it?
next class.
No. Questions, what?
Let's say, for example, question 20.
You are valuing an investment that will pay you 12,000 the first year, 14,000 the second year, 17,000 the third year, 19,000 the fourth year, blah, blah, blah. What is the value of the investment to you now? What is the value of investment now is appropriate annual discount rate? I guess what they're saying is, what is that? What is the present value of all those future cash flows?
So you have to work each one individually.
You gotta do each one. Why? Because they are not level payments or what we call an annuity. So each
Okay.
one of the okay.
Okay.
So if we look at the solution, if you go to the solution, the question 20, you'll see where they did the same thing. Cash flow 1, cash flow 2, cash flow 2, they brought them all back to the present value.
Okay.
It's arduous a little bit, but that's the way you do it.
Okay.
Okay. Anything else? Please, if you still don't understand something, you have my email address. You can email me the question and or we can do a separate couple of minutes if you want to, okay? Because I really want to try and cover, I'm paid to cover this material, okay? So I want to make sure I get through it.
Okay.
That's okay. We are at part 2, I think. Learning objectives for part 2 is fixed income securities. What they're trying to tell you is to know the difference between fixed income versus equity securities versus derivatives. Okay. What do you guys know about fixed income securities? Give me an example of a fixed income security. This should be pretty obvious.
Salary.
A mutual fund.
That's not a security.
A mutual fund.
That's a cash flow. Come on, guys. Come on. We spent all
Mutual
class.
fund?
We spent all last class talking about these. I was
A
talking all
mutual
about.
fund.
A government bond.
There you go. A mutual fund is not a fixed income security because it pays dividends. Now, okay, the mutual fund may be
Annuity.
a bond mutual fund, then it may, but still in all, that's not a fixed income because the income, because it's pooled in various bonds, the income changes, so it's not fixed. Okay? If you flip the page over, it gives you a couple of things: certificates of deposits, treasury bills, treasury bonds, corporate bonds, municipal bonds, even junk bonds, if they pay.
What all them is?
Look, all of these are fixed income products, page 14 in the manual. Rifman, what's a certificate of deposit? Tell me what a certificate of deposit is. You've been awfully quiet today.
Say it again. Sorry about that.
What's a certificate of deposit?
Term deposit. Generally a fixed
Okay.
deposit or whatever what the bank would have. Generally those are certificate of deposit or CDs. That's an example of one.
Great. So a fixed deposit is normally issued by a financial institution such as a bank. It's for a fixed term with a fixed interest rate, correct?
Correct.
Great. Joseph, tell me what a treasury bill is.
A T-bill?
A T-bill, that's it. That's your answer, right? Tell me some of the features of a treasury bill.
Okay, let me just give it a shot. I think one of the features it's paid semi-annually, right?
Nope.
No?
Nope. Nope.
Okay, mixing it up then.
A treasury bill is a tricky thing.
Yes. Let me see here.
It's a government bill.
Yeah, but some of the features of it. Okay, it's issued normally by the government.
But that.
Ergo the treasury. What differentiates a treasury bill from a treasury bond? Okay.
Short the term.
That's one, right? Tell me a little bit about it. What do you mean by the term? What do you mean by the term?
And length. So I would
Treasury
think
bill.
a bond is longer and the treasury bill is a shorter term.
Yes, that's correct, man. What else you know about treasury bills versus treasury bonds?
So the treasury bill, it have like a period of time on it, like probably 2 to 3, 4 years. And then the treasury bond has a more longer years in terms of like 20, 15 years, I guess.
Okay, y'all
The
hit
bond
me
is
around
just
it.
longer. The bill is shorter.
The treasury bill is a short-term instrument normally of 1 year or less, right? A treasury bill, unlike a bond that's sold at par or the face value, say 100, a treasury bill is sold at a discount, okay? Meaning you will, let's just say, if you bought a treasury bill 1 year with a discount rate of 10%, right? You would probably pay $90 for the treasury bill, but at maturity in a year, the government will pay you $100. Ergo the term, you buy it at a discount. Unlike a bond, you buy the bond at face value, and based upon the face value, you are paid a set rate annually or semi-annually. Does everybody understand what I mean?
Okay.
I
Yes.
understand. I understand.
Good? Corporate bonds are obviously bonds issued by corporations as opposed to government. Treasury bills, treasury bonds are issued by the government. Corporate bonds are issued by corporations in their attempt to raise financing. They are riskier than treasury bonds, treasury bills, obviously, because it's a corporation backing it as opposed to the government backing the treasury bonds, treasury bills. And they trade fairly much as any normal bond would trade, okay? A municipal bond is a bond that is issued by a state, not the federal government. They call them munis. Same concept though, they are traded like every bond, they behave like bonds. Now, they go on to talk about bond ratings in order to help, somebody has some background noise like a TV or a radio going on. Okay, thank you. Bond ratings, there are institutions in order to help an investor in terms of determining the type, if they're looking at bonds and they determine I want to buy some fixed income securities, great, I'm going to invest in bonds. Then they determine, okay, which bonds am I going to invest in? Categories such as government bonds, corporate bonds, or municipal bonds. In order to assist with this, there are agencies that come up and they rate the bonds depending upon what they deem to be the strength of the institution backing the bond. So we have here, there are rating agencies such as Standard & Poor's, Moody's, and Fitch. They are the three most popular ones. And the book goes on to say how they are rated. They assign, like Standard & Poor's and Fitch, for a top-rated bond, they assign AAA. A lower-rated bond is AA, and they go all the way down to D, just like high school. Moody's have the same thing, but the concept is the same. They are there to assist investors in guiding them in terms of what is the risk associated with this particular bond. And ergo, if you are aware of the risk, you know the chance you're taking, are you being fairly compensated based upon that risk? Obviously, let me put this out here. A bond, what would you expect in terms of the interest being paid on a corporate bond versus a treasury bond?
The longer, I would think the longer the term, the higher the
No,
interest.
wait, hold on. We ain't get the term yet. We ain't get the term yet.
The treasury
talking-
bond should pay a lesser interest because the risk is less. So the higher the risk, the higher the return. Lower the risk, lower the return, so to
Hey,
speak.
Rickman, say it real slowly again. We ain't got no place. You sound like you're in a rush. Say it real
Sorry.
slowly.
So generally, the higher the risk, everything is based on the risk. So if there's a higher risk, generally there's a higher rate of return or a higher interest rate. So in the example you gave, the treasury bill, which is issued by the federal government, carries a lower risk because it's the government. Hence, it's generally issued at a lower interest rate as opposed to a corporate bond, which will be at a higher interest rate.
Okay. Thank you, Richmond. Does everybody understand what Richmond said? Yes?
Yes.
Great. Now,
Yes, sir.
Melissa, I think it was somebody talked about the term. Okay. Who talked about the term? They shouted over the term.
I did.
Not me.
Chanel. Okay. Tell me now. We talked about the issuer, right? Great. Normally, what is the rate you should get as the longer your interest is, the longer your money is tied up? Chanel?
What is the rate you should get?
No.
A higher rate.
Why?
Because the risk, it's for longer term and your monies are tied up and
That's all you need to say.
the risk
That's all you need to
okay.
say. That's what they call the liquidity risk. A longer term bond is not as liquid as a shorter term bond. So we've covered two types of risks here: issuer risk and liquidity risk, or time risk. Anybody got any questions about those two concepts?
I did. I actually thought that if the term was shorter, then the risk would have the rate would have actually been higher than in comparison to if the longer the risk, the longer the term, the higher the rate.
Okay, that's fair. That's fair, and thank you for offering that. When you said you thought, let's rationalize this. What led you to believe that, Ms. McDonald? Just something you read, or that was just your understanding?
That was my understanding previously of it, because I've always thought, yes, I've always thought that, and it was something that I read before. I can't put my hand on my mind to it to tell you what it is that I've read. But it was my understanding that when the risk, if it is higher, then more than likely the term period may have been longer. Would have been shorter, which would be the higher interest rate because of the risk. And also the term. That in comparison to whether it was something for 5 years, then it could have been at a lower interest rate because it's seemingly more secure and it is for a longer period of time.
Okay, let me try. Okay, you have $5,000, right, of your own personal money.
Yes.
Take you a long time to save that money, right? Somebody comes to you and asks you to borrow that $5,000 they want to borrow it for 10 years. Okay?
Mhm.
Another person comes to you and asks you to borrow the same $5,000, but only for 2 years. In your estimation, that proposal, which is the more riskier proposal for you to lend out your personal hard-earned money?
In 2 years.
In 10 years.
Well,
No,
given the 10,
Mr. Dawson, hold on. We're trying to leave
given,
Miss McDonald.
given the 10 years, okay. Okay, yes, you are right. You're right. From my explanation, yes, you are right. It's the
That's
10.
a long time.
Yes,
You ain't sure that
you're
coming
right.
back.
You're right.
ain't sure that coming back.
You're right.
To build a house in that time.
Not
Yes,
only that,
it is the 10 years.
okay, there's so much uncertainty. Not only that, suppose interest rates shift during that 10 years, and what you was charging that person on the interest rate has now, you could have invested in something else during that 10 years to paying you a higher rate, but you locked in.
That's true.
So, Ms. McDonald, and we're here, I'm just your coach. I'm not your teacher. We try to rationalize things so that it makes sense to you.
Mhm.
Okay? Nobody's here to judge anybody. It got to make sense to you. These concepts, okay?
Mm.
All right, like you are Mr. Riffman. No, Mr. Adley come to you. Mr. Adley got a nice job. He work in the bank. He's a suit.
You do, Joseph?
Huh?
He does?
I
No,
think
he
so.
Tampa.
He want to borrow $500 from you, right?
Mm-hmm.
Okay.
Yes, sir.
Now, you've been contemplating this, but you know, the gentleman, you was driving by the mall, coming off the highway, just going to the mall, and you get stopped at that multi-part stoplight, okay?
Yes.
And you know the guy who will sell the water and the peanut on the side of the road, right?
Yes.
Okay, he come to you and asks you, he want to borrow $500 too.
Oh, wow.
Who will you lend your $500 to?
Man, Joseph work at the bank. He more likely to give me back my money.
Why not the guy who to sell the water? He is there religiously every day.
Man, but I can find Joseph at the bank. I can't find the man.
He got
Maybe
a-
somewhere else.
He got a steady job.
Tis true. However, I still feel as though it's easier for me to go ahead to find Joseph, not only his job. It seems more rational to me to lend it to Joseph.
Let's put it in financial terms. Based upon the knowledge at hand, Joseph appears to be less
More
risky.
financially stable. Yes, and less risky.
Carries a less risk. Okay. What if I told you, Mr. McDonald,
Yes.
you have to lend, here's $500. You have to lend some of this to Joseph, and you have to lend some of it to the guy on the street. Just urban renewal and social and all them things. You gotta lend him something.
Mm.
What is the rate you will charge Joseph, and what is the rate you will charge the guy who to sell peanuts?
Charge Joseph maybe at a 5.
Uh-huh.
I charge the guy who for the peanuts between 8 to 10.
Why?
Because to me, the guy who sells peanuts, it's more of a risk, and I gonna want my money quicker. So I'm gonna have to shorten the time period and increase the interest rate of which I'm letting in the funds than
Now,
Joseph, which is more secure.
now, when you say a question like that and they talk about risk, I just want you to remember them things. You just work your way through the whole risk concept.
That is awesome.
See, I like to flip this. When we talk about bonds and corporations and so forth, I like to put it in your lap. What if it was your money?
Oof.
I'm sorry I've digressed. Does everybody get the concept of what I was trying to show Miss McDonald? Is it clear? Confusing?
I understand.
Great. Nothing against the guy who's selling peanuts and water on the side of the road. Nothing against, they're enterprising, they're entrepreneurs. I have nothing against them. I'm just talking conceptually and factually in terms of risks. If you have an investment portfolio, how would you divvy up your investment portfolio and what price will you demand for your money based upon the instruments you're going to be investing in? Okay, let's talk about risk. They have a section called Key Risks of Fixed Income Security. They speak about interest rate risk. Bond prices are inversely related to interest rates. Oh, that's a big one. Who wants to tackle that one? Explain that one. Who's iPhone? I see some on my screen say iPhone.
That may be me. I'm not sure if that's me.
Okay, since you volunteer, tell us about it.
No,
I
volunteer.
No. I pick you. Tell us about the inverse relationship between interest rates and bond prices.
The inverse relationship between interest rate and bond pricing. So I'm assuming here, if the interest rate is high, meaning the return is going to be high, they're going to try and sell it cheaper. This is an assumption.
That's
so
if, okay. You are absolutely correct, sir.
So if I think, as you mentioned last class, you were talking about, for example, if you buy an apartment that has rental income, and if the return on this investment is going to be 50%, I have more wiggle room to sell you it at a reduced price or a discount, because the investment or the return higher, I'm assuming.
Yeah, but let me keep it in the realm of bonds, okay? Let me keep it in the realms of bonds. Let me try to explain to you. By the way, I got to digress for a moment. Angelica, are you there?
I am.
Angelica, you work for Royal Bank, right?
I do.
Tom there?
Yes, sir.
You do realize.
And for me as well.
You do realize you were my account officer one time, right?
I know you as your account officer. You know as your account officer too.
That name just rang a bell when I was doing it later on. I mean,
Yeah.
you're the only reason I keep my account at Royal Bank. Royal Bank Services is something.
Oh Lord.
You want to help you get a loan, credit card, car, personal line credit.
Say that again?
You want to help you get a new auto vehicle, credit card, person wanted credit card limit increase, upgrade.
No, man, that's fine. He come to Commonwealth Bank.
No, he said office in Angelica.
Better yet, Fidelity offer the better rates.
Anyway. Let me tell you something. We can get to this. We can get to this in a little while. All those things you guys are mentioning, I am trying to divest myself from them. You know why?
Because of the economy.
No, I'm 63 years old now.
Oh,
Car loan, don't want it. Credit card, the only reason I carry a credit card is for medical emergencies. But we're going to hit that later on here when we talk about investment products and so forth based upon the time frame you are in your lifespan. We'll get to that. But Angelica, nice to be reacquainted with you. Mr. Risman, let's go back to this example about interest rates and the inverse relationship between interest rates and bond prices, okay? Year one, the central bank issued a 20-year bond paying 5% interest, okay? It was a fixed rate. What do I mean by the fixed rate? That means that the rate cannot be changed if interest rates in the market change. So it's fixed. It's fixed, okay? Now, subsequent to issuing that 20-year 5% bond, interest rates started to trend up. And Mr. Rithman, let's just say you bought $100 of that 5% bond, okay? Interest rates have now trended up. That same bond 2 years later is now not a 20-year bond, but an 18-year bond. But in the marketplace, 18-year money now is being paid, interest on 18-year money is being paid at 7%. Okay, Mr. Rithma?
I got you.
You ran into an emergency. You need to sell that bond.
All right. I follow you now.
Okay, you need to sell that bond. So you approach Angelica and you say, Angelica, I have this government security that I want to sell. $100 of it is paying you 5% a year. Angelica goes and does her research. She finds I could go buy a new bond and get 7% of it. But use a friend. She will help you out. Now, Angelica, what price would you pay Richmond for his 5% bond? That is, the face value on it is $100. When you know that you could just go right to the central bank and buy an 18-year bond at 7%, but you want to help them out. What
I'll
price
buy it
would you'll buy it for less?
Mm-hmm.
Why?
Or reduced. Because the fact that it's a fixed rate in the market right now is higher. So really and truly, I could find something in the market and get more interest. But because he is trying to transfer this instrument now, or he wants to sell the bond, I'm really doing him a favor.
So what price would you pay for him? What price would you pay him for his $100 bond that's yielding 5% in a 7% market?
Um, you said it's $100.
Uh-huh.
Maybe because it's a bond, maybe I might take 170, 75. No?
What you're
Cold.
trying, no, she's on the right concept. What you're trying to find out, you are going to tell Mr. Riffman, I am going to pay you a price that would make the face value of this bond equivalent to the 7% interest. So instead of paying him $100 on the bond, you may pay him $99 because $99 at 5%, growing to be $100 is the same thing as buying a bond, $100 face value bond at 7%. Y'all understand the concept I'm trying to get at?
Mm-hmm.
Yes.
Okay? So when they talk about interest rate risk, whenever you buy a fixed income security, there is always the risk that interest rates in the market may change. You got me?
That's all.
Okay.
Yes.
Y'all could read about that, but that's conceptually it, okay? Interest rate risk is you locked into a fixed income security. Interest rates in the marketplace can change. They can go up or they can go down. Now, Mr. Riffman, let's go back to you. Yes? You got a 5% bond. Face value $100. It's not 18 years. You need to sell this bond, but interest rates in the market for 18-year money is now only 4%.
So now I could sell it at a premium because the return is better.
Okay, explain what you mean by a premium.
In terms of it, if it was valued at $100, then I can now sell it for 105 or 110 because the value of it, the future value of it is going to be more.
You got it. You got to sell it at a price that would yield the equivalent of what 4% is. So it may be at 101, 102, even up to 105. Correct. Okay, fantastic. In other words, if you buy a fixed interest security and the interest rate structure in the market changes, the only adjustment that can be made to bring it into sync with the market is through the price. Does that make sense?
Yeah.
Everything else is fixed. The term is fixed. The coupon rate is fixed. The only thing that you can adjust is the price. Good? Call and prepayment risk. Normally, some institutions, when they issue a bond or a thingam, they issue it with, I can call the bond or I could buy the bond back from you at a given date at a given price. So that's the risk, okay? Because you may not be locked into the bond for the whole 30 years. Prepayment risk, in a lot of contracts, they have the ability to prepay the bond before its scheduled maturity date. Yield curve risk, that's what I talked about the yield structure in the market changing. Okay? Reinvestment risk. This has to do more with the interest that you earn and a maturity and a security as it comes to maturity. Remember the concept last week when we talked about compound interest? We always assume that the interest that you get from the bonds can be reinvested at the same rate as the coupon rate. Yes?
Yes.
Is that clear to everybody? Please, guys, stop me, because some of these concepts, if you do not get it, if you don't grasp it, you don't have the foundation to build upon. Now, the risk with that's an assumption in compound interest. Compound interest, that's the only fault with compound interest. It assumes that the interest can be reinvested at the interest of the coupon. As you know, that's not always the case. Okay? We talked about credit risk. McDonald, give me an example of credit risk.
When people don't pay the loan off, default.
Miss McDonald, give me an example of a credit risk. Give me a scenario of a credit risk.
Okay, credit risk. Can you hear me?
I'm here, we can hear you. If you had to explain credit risk to class, how would you explain it? Give me a scenario you will explain it in.
Okay. I would say a credit risk would be giving a 65-year-old man a credit card who is already retired and receiving.
Ouch, you mashing all my corn here. You jumping up and down on my corns now.
Who very well may or may not be receiving pension,
Wow.
knowing given his current circumstances, maybe if he is a current customer and we are familiar with him, yeah, given his current circumstance, I think that will be a credit risk.
Okay, that's a good one. Miss McDonald, give me an example of credit risk.
That wasn't my example.
Let me tell you, Joseph and the Peanut Boy.
Lord, yes, Joseph and the Peanut Boy. Okay.
Okay. Why do you think I chose you specifically for that? Liquidity risk.
Yeah.
Liquidity risk. Risk that the bondholder will need to sell the bond at a discount to its value. That means bonds, fixed term or long term instruments are not necessarily liquid. Short term instruments are, they got more liquidity. I think as bankers, you all can figure out exchange rate risk. And obviously everybody knows inflation or purchasing power risk. That means, every time, the longer your money died up, when you get the money back, it may not have the same purchasing power. Yes? Now,
Yes,
this one,
Correct.
event risk. Everybody give me an example of an event risk. The event risks are external shocks that reduce or eliminate the issuer's ability to meet its obligation. Everybody give me an example of an event risk.
Like a hurricane.
Yes.
COVID-19.
Or COVID as well.
COVID-19 is an event risk.
Natural disasters.
Well, COVID-19 wasn't a natural disaster. That was a man-made, but that's why they say an event risk. May not be natural. Bond pricing. They go on to talk about the inverse relationship between interest rates and bonds, the relationship between price and discount rate, same concept. This is a tricky one too. Now let's go on to the concepts of duration and convexity. Duration is a measure of the approximate sensitivity of a bond's value to rate changes. So we know that there's a, Mr. Rithman. Hello? Mr. Rithman.
I'm here.
We know there is an inverse relationship between bond prices and interest rates, right?
Right.
Okay. Duration tries to measure exactly what that relationship is. Meaning that if interest rates change by 1%, exactly how much will the price change? That's duration. Okay? So there's an inverse relationship, and duration tries to measure exactly the magnitude of that relationship for each bond. Okay?
Okay.
More specifically, it is the approximate percentage change in value from a 100 basis point change in interest rates. 100 basis points is 1%. That's what they call 1%. While we are not going to calculate duration in this course, the reader should note that duration equation is linear. What do they mean by that? What's a linear relationship? Okay. A linear relationship means that once you've established it, a 1%, a 100 basis point change in interest rates will cause a 5% reduction in a 30-year bond, okay? Ergo, if 1% causes 5%, 2% will cause how much percentage change in price?
10.
A 3% will cause how much change?
15.
You got it. That's a linear relationship. Okay, it's constant. Convexity measure. The convexity measure adjusts the duration calculation upward when the discount rate declines and downward when the discount rate, same concept. Movement up and down on this linear scale. They ain't gonna get into it that deep in that. Principles of valuing a bond. The present value of a bond is based on taking, who I can get to read this? Angelica, are you there?
Oh, yes, sir.
You have your book open?
No, sir. You could choose somebody else. I want that one.
Okay, not a problem. Who was it that had a problem with question 20? Was that you, Miss McDonald? Who asked me to go
No,
over?
sir, that was not me.
Patronelle, Patronelle or Chanel. Who asked me to go over question 20? That's when they had the various different cash flows.
It wasn't me.
Okay, so it must be Chanel. Anyway, here's the concept of valuing a bond. Principles of valuing a bond. Anybody want to guess how they value a bond? What's a couple of the things we know about a bond? You put down your principal and you get, let's say it's fixed rate, okay? You get interest paid to you, right? Yes?
Yes.
Is the interest consistent?
Yes.
So therefore, what is a bond?
What do you mean? What is a bond?
The interest flows on a bond. What will we call that?
The money that you.
Trying to understand your question.
I know, Richmond, I figured that. Okay, let me make it simple. There are annuities. Yes?
Right.
So how would you find the value of a bond?
You would look at either the future, the present value. No, you mean it like that?
Yes, ma'am. Tell me how you find the value of a bond. It's very simple.
The present value of the
You have to
interest.
look at the present value.
Plus the present value of the principal.
That's one. That's one.
The future value of the principal.
No. You're trying to value a bond, a 30-year bond, valued today. Angelica and Richmond, remember I gave you the example of Richmond trying to sell you a bond, the coupon rate on it is 5%, right?
Mm-hmm.
But interest rates in the market have changed to 6%, right?
Uh-huh.
Now we getting into the mechanics, how Angelica will work to find out exactly what she will pay Richmond for that bond.
So I have to look at the market.
No, conceptually. Don't worry about the figures right now.
Mm-hmm.
Let's strip down the characteristics of this bond. You know, let's look at the cash flows that you're going to derive from this bond, okay? You're going to get 5% interest. You're going to get $5, is it? Or 50 cents on $100. You're going to get $5 every year for the next 18 years. And then at the end of the 18 years, you're going to get the $100. Tell me, guys, what's the cash flows associated with this bond? That's it. I just told you. You're going to get $5 per year for the next 18 years. $100 for 5%, right?
Right.
And then at the end of that, when it matures, you can get the $100. Yes?
Right.
Right.
So how would you go about finding the present value of that bond?
That's the future value? No?
No, you're trying to determine what you can pay Richmond today.
Oh. know. I mean, if you ask us to calculate, I don't know if you asking this question, right? Because I lost. Because if you ask us 5%, that's $90. $90 plus $100, that's $190 we get at the end of it.
That's not what I'm asking you. I tell
But
you
that's
the
not what you asked. Okay, that's
Okay, let me address the question different. What? No, that even know. Okay, the $5 for 18 years, an example of what type of cash flow? It's an
you said
annuity, right?
Yeah,
Yes, I know.
annuity, income cash flow. Yeah.
Okay, a level constant cash flow, right? So if I need to take all those, if I tell you all to find me the present value of those cash flows, how would you all go about it?
Yes, we'll use the annuity table and use the period and the interest, and that'll
You
give
got
us a value to calculate.
You got it. But you take the 5%, yes?
Right.
No, but hold on now. You know what the dollar value is, right? That you're gonna
So
get.
the dollar value is going to be on the $100, which is the initial principal, and then we can use the annuity on the $5. No,
That's
on the
correct.
5%.
That is absolutely correct. Break it down in segments and explain to them what you mean, Resman. You're not quite clear.
Okay, I'm just guessing here, but I'm assuming if the interest is essentially annuity payments or fixed income, we can find
Right.
out what the value of the fixed income would be. So we will use the table for the interest payment.
No. First of all, we determine what's going to be the cash flows, the fixed cash flows from this investment. We know that it's $100 at 5% per annum, right?
Right.
right.
So that means you're going to get $5, right?
Correct.
Right? For the next 18 years, you're going to get $5 from this bond, okay? Everybody agrees with that.
Yes.
Okay, now that $5 though is the equivalent of 5% on the $100, but interest rates have changed. You are now demanding 7%. Take it from there, Riskman. Tell me what you'll do.
Just your old spoken, maybe. I just when you change it to 7%.
Minus 7%. I mean, and that's a bond. You'll have to sell that and buy it.
So that mean first I have to calculate what the present value of what this 5% looks like.
No, you first of all calculate the cash flows you're gonna get.
Oh, you mean on 7%?
Nope. You have calculated the cash flows that you're gonna get from this investment that you know, right? Now, what you are gonna do is take all of those cash flows and discount them back to the present value at 7%.
Okay, so I find the present value of that $90 at 7%.
Not the 90. What $90 we talking about?
The $90 would have been the cash flow.
No, the
sorry,
cash flow.
The $5. Sorry.
Okay. So you're going to look for 18 periods at 7%. What factor you get?
Hold on. Trying to opening up the table. So we're using the annuity 18
Present value of an annuity. Joseph, I know you already got this figured out, eh? You're just sitting in the background snickering, right?
You all have me in circles right now.
18%, 18 periods at 5% is 11.
I thought it was
I
at
didn't.
7%.
I didn't say 5%.
Sorry, 7 is 10.059.
The present value of an annuity present value factor of an annuity. You sure
Right.
you're using present value?
Present value factors of a $1 annuity.
No. Okay, of $1 annuity. Okay, I'm sorry. Let me catch up with you. Okay, we said 7% for 18 periods, right?
Right.
And you said 10.059. I agree with you, sir. So we'll take that $5 and multiply it by that.
Okay.
What you got? What you got?
$50 and I guess 30 cents.
Okay, $50.30. We write that down, right?
Right.
There is one other cash flow that you have to discount.
Which is the $100. Which is the initial bond itself.
That's correct. The face.
So then I'll have to look at the present value for the $1.
There you go. I thought you was gonna miss that one, but you sure have tonight.
I guess I'm hungry. I'm eating on dinner. That's the problem. So are you doing again 18 periods at 7%?
Mm-hmm.
Let me try that 18. You're looking at this, right?
Mm-hmm. I got you.
That's sorry, looking at this right now. That's 0.296.
And 18 is 0.2. Yeah, 296. 296. You could do so. Multiply that, and what you get?
That's 100 times 0.296. 2960.
What you think you should do now? What you think you should do next?
So I add that to the 50.
You got it.
30, which is $79.90.
That's how much she should pay you for that book.
Okay, so what we're doing is we finding the present value for the annuity payments at one point, and then the present value for the lump sum, and then we simply just add them together, and that'll be my total present value for the bond.
That's correct. Assuming that you have a fixed rate, that you know what it is, and assuming that you know what the interest rate structure, the present interest rate structure in the market is.
Okay.
That make sense?
Makes sense.
Rittman, where you got the 0.296, which schedule you use?
The present value for the $1.
See, this is two types of cash flow.
So
First of all,
we break it up.
So first we did the present value of the annuity.
Correct.
And then the second calculation we did was the present value of the lump sum, which was the 100.
Yeah. Right.
Okay. And then when we add them together, that would be what?
The $79.90.
No, I mean in,
And then when we add it together, that would be the total present value of the bond,
okay,
inclusive of the payment. So if
okay,
I'm selling it, that's what I'll be selling it as.
okay, gotcha.
You got it? Does anybody do not understand, at least conceptually, what we just did in bond valuation? Let's read what the book said. The present value of a bond, the present value of a bond is based on taking all of the future cash flows of the bond and discounting these cash flows at a given discount rate or interest rate. Let's assume we have a bond that matures in 5 years and pays its coupon annually. Also, the bond's coupon is 10% and the discount rate is 9%. What is the present value of the bond? Who want to take this one?
I think I could take it if nobody else want to take it. But we don't have a dollar value for the bond itself. Let's assume we have a bond.
Let's just
But
say it's $1. Let's just say
the
okay.
fact-
Let's just
the
say it's
fact-
$1. Yeah, I mean y'all can put in whatever factor. Y'all want to do $1,000?
Yeah, get it $1,000. So if we using the $1 one now that I in it, and we using it at 5 years, so that's 5 periods, and the discount rate is 9%. So we'll use 5 periods at 9%.
No, hold on. No, you missed a step. You can't do the dollar yet.
Oh, I thought we just doing the separateness added together.
No, you can't do the dollar yet. Let's look at the steps I gave you. The last example I said you had $100 paying you 5%. What's the first thing you did was to determine?
We found all of the cash flows.
There you go. So listen to this now. Let's assume we have a bond that matures in 5 years and pays its coupon annually. Also, the bond's coupon is 10% and the discount rate is 9%. What you gonna do?
In this scenario, the bond coupon is 10%, and we're using $1,000. So 10% of $1,000 is what? $100.
Yeah, okay.
So that's $100 every year for 5 years.
You got it.
Right.
Okay.
Which is $500 over the cost of the bond.
Yeah, but what you're gonna do with those cash? First of all, is this an annuity?
Yeah, because it's a fixed.
It's level cash flows. It's level cash flows, meaning the cash flows remain the same. They are not unequal cash flows. Okay? So you got $100 that's happening for the next 5 years. What you can do with it, my brother?
Find the value of that cash flow.
You find the present value.
The present value of the cash flow.
Great. How would you go about it? But come on, man. Someone else pick up from here.
You take all the cash flows and we would discount them at 9%?
That's correct. So go ahead, Patronelle. Did you get the discount factor sheet I sent you? Yes, you did.
Yeah,
see
I
you
got
did
it.
Great. Take us through it. Tell me what you're doing.
Okay, so So we're looking at 5 years at 9%.
And what factor tables, wait, first of all, Patronelle, what factor tables are you looking at?
I'm using the present value interest for $1 discounted.
No, you're in the
No?
wrong factor tables.
Okay.
What did we say this type of cash flow
Oh,
represents?
it's an annuity.
There you go.
Annuity discounted table I'm using. Yeah.
Okay.
So it's 5.
So it's 5 periods at 9%. What factor do you get?
So that's 3.8897.
Great. So we're going to take the south, we're going to take the $100 and multiply it by that. What you got?
So that's 388.97.
Okay, great. So we put that aside. Now, what's the next cash flow we got to work on? What's,
Present value lump sum.
okay. Present value of a lump sum, 5 periods, 9%. Got it?
Sorry, I'm looking right now. Sorry, would I be looking at the table for compounded?
No, you're looking at the present value interest factor for $1 discounted.
Okay. So that would be 6499.
Yes, ma'am.
And
So
then
you
we would
multiply-
multiply that by we'd multiply that by the 1,000.
That's correct, ma'am. What you get?
So 649.90.
And then what you gonna do with that?
We gonna add that to the 388.97 we got previously with the annuity, the present
And
value of the annuity.
Great. And what did you come up with?
And I got 1,038.87.
That's correct. Why is the price higher? Richmond, this goes back to you. The person who is selling this spot is demanding a premium. Why?
Because interest rates might have changed.
Angelica, answer this question. I know you got this question, Angelica. Why is this person asking a premium for this board? Anyone? Anyone?
Is it because interest rates changed?
It is, but be a little bit more specific, Pranella. Look at the information that is in front of you. Why is this person asking a discount, asking for a premium?
I don't know if it ties back. I'm guessing, yeah. If it ties back to when you said earlier, where is a fixed rate The only thing you could adjust is the price.
That's correct. You absolutely correct.
Okay.
Look at the question and tell me specifically for this question, why is he asking a premium?
Because the rate dropped from 10% to 9%.
You got it. You got it. The coupon rate higher than the current structure of the rate in the market. In this instance, it's selling at a premium. Suppose it was 11%, it would be selling at a discount. Okay, I think we've labeled that. Calculating the accrued interest due on a bond. Any other questions about that before I move on? Now, all you bankers should know all about accrued interest. What do they call it? The per diem interest of what? First of all, let's break down the concept of accrual. What does accrued mean?
Accumulating.
Pardon me?
Accumulate.
Exactly. Let me give you a definition. Interest earned but not paid. Everybody cool with that?
Yes.
Interest earned, but it hasn't been paid yet. Yes?
Yes.
When calculating the accrued interest on a bond, the first step is to determine how many days have passed since the last coupon payment. The second step is to determine how many days there are between coupon payments. The industry convention is to assume each month has 30 days and the year has 3. Guys, I'm not even going to touch that. You all are bankers. You all should know how to do accrued interest. I need to go through that with you. Am I correct?
Well, would you still like to go through it just once?
The second step is to determine how many days there are between coupon payments. The industry convention is to assume each month has 30 days and the year has 360 days. For example, if the last coupon was paid on March the 5th, which is day 64 of the calendar year, and the bond is being purchased on June the 10th, day 161, then the number of days that have passed since the last coupon payment would be, somebody tell me. Guys, come on, man. 161 minus 64 plus 1. $161 enter 64 minus okay, let's break it down. March the 5th to March 31st is 25 days, right?
Yeah.
Now, the big assumption here is what? Exact days, it is not, because if you take 5 into 31, it's actually 26 days. Why are they saying it's 30? Because that's what the industry measures months in. Okay?
Yes, sir.
So you see the calculation there? It's assuming that every month has a 30-day period, even though some months are 31. So the maximum for a month gotta be, you got to take something, if it crosses over the end of the month, the maximum you got to take it from is 30. Does that make sense to you guys? In computing accrued interest for the bonds, okay? Now, you will see in the last one, June 1st to June 10th, then they use 10 days. That's 10 minus 1 plus 1 because they earn interest on the 10th too. You good with that, guys?
Yes, sir.
Okay. Equity securities. So we finished with fixed income securities. We're going on to equity securities now. What's the difference between a fixed income security and an equity security? When you purchase a bond of a company, what are you literally doing? What type of funding? What type of funding are you giving to that company?
That's a debt. That's a loan.
That's a loan, right?
Yeah.
When you purchase a company's stock, what type of funding are you giving to the company?
That's equity. That's ownership. You own it. You buy into the company.
That's what I was after. One is a loan, and one is you buying into the company. That's
Yeah,
exactly.
I got you.
All right. Preferred stock. Now, there's a difference there. There's common stock. That's when we take equity, we normally mean common stock. There's another thing that's a hybrid that's called preferred stock. Preferred stock is a class of ownership in a corporation that has a higher claim on the assets and earnings than common stock. Preferred stock generally has a dividend that must be paid out before dividends to common stockholders, and the shares usually do not have voting rights. Quite often, preferred shares have provisions whereby if certain preset conditions are not met, then certain steps can be taken to better protect the preferred shareholders' interests. For example, the preferred shareholders can pick a member or members of the board of directors. Some preferred stocks are perpetual. That means they go on for as long as the company is alive and kicking, which means they do not have a maturity date, while others have a maturity date. A fixed rate perpetual preferred stock issue is an example of a perpetuity. The issuer of the preferred stock promises to pay a fixed amount every period, usually quarterly or semi-annually, forever. A fixed rate preferred stock with a maturity date is similar to a normal bond, other than having a lower claim on the assets and earnings of the company. Does everybody understand what I just read? And that's the one thing I will read verbatim from this. Does everybody understand that?
Yes.
Yep.
We good? Great. Let me ask you all a question. Let's tell me, based upon your knowledge, if a company was to go bankrupt, right? And you have persons that hold bonds of the company, hold preferred stock of the company, and hold common stock of the company. Give me the order in which they would be paid. Who would be paid first, who would be paid second, and who would be paid last?
The same order.
Unpreferred common stock.
Okay, let me hear it. Who would be paid first?
The
Bonds,
bondholders,
Okay.
and then
Who
the
would-
preferred stockholders,
then the common.
and then the common.
Y'all got it. Okay, great. Y'all understand what I'm talking about. Common stocks are units of ownership. Fine, no problem. You all know what common stock is. All right. Key ratios, descriptors used to evaluate common stock. 52-week high, low. This is simply the highest price and lowest price at which a stock has closed over the last 52-week period. Year-to-date changes, the dollar change in share price during the year since December 31st. Year-to-date percentage change. This is just a percentage that it's changed. Market cap. The share price multiplied by the total number of issued and outstanding shares of the company. Shares outstanding, total number of issued and outstanding common shares. Float, total numbers of shares that are outstanding and available for trading by the public. Short interest, total number of shares that have been sold short and have not been repurchased to close out the short positions. Y'all understand what a short trade is? It's
No,
not
can you
important.
elaborate?
No, don't, you can get confused. Believe you me, they ain't gonna ask you about that on this exam. Beta, the variance of a stock in relation to the rest of the stock market. It's a measure of how a stock price changes in relation to changes in the value of the stock market. Okay, I did something wrong just now. You asked me to explain what a short sale is, and we after education, not only what's going to be on the exam. So I apologize. I think that's Ms. Donna McDonough. We after education here. Sometimes in the marketplace, I'm going back to the short interest. Sometimes in the marketplace, a person may believe that a company's stock is going to go down. They may have some information, a feeling, whatever. So what they do, in the marketplace, they call, would they sell it short? They don't own the stock. But they can track that. That's like me telling Mr. Rithman, Mr. Rithman, I'm going to sell you, what bank do you just work for, Mr. Rithman? What bank do you work for?
Scotia.
I can sell you 25 Scotia stock. The current market price is let's say $10. I'll sell you that stock for $9 but it got to be for trade date, for delivery date on the 15th of February. We now at the 21st of February, right? Why would Mr. Riskman buy that stock? First of all, the current market price is $10, right? Yes? Mr. Riskman will buy the stock because I selling it to him for $9. He already make $1. Why would I commit to something like that? Because I believe the price can drop below $9. Which would allow me at the time of settlement, right?
Right.
Is to buy this, let's say the stock drops to $5, right? I buy the stock. I don't own the stock now, but I enter into contract with Mr. Riskman to sell him this stock for $9 on February the 15th. Yes, I got to deliver that to him, right? So if things go as I plan, the stock would have dropped to $5. I go out, buy the stock for $5, give Mr. Riskman his 5 shares, but he doesn't commit to buy him from me for $9. So even though the price doesn't drop, he doesn't commit to me. He got to give me my $9 and suck them for.
Oh, wow.
Now, Mr. Riskman would have bought the stock because he has the opposite view of me. He thinks the stock can keep going up or at least hold value.
So I hope to win $1.
Let's take the other scenario. Suppose instead of the stock going down to $5, it went up to 12. I now, on the 15th, go buy them stock for $12 and sell them to Mr. Riskman for
For
$9.
10. Yeah.
For $9. For the
Yeah.
$9. So I suck in that $3. That's what you call a short sale. Very, very risky.
Yeah, that's where the money is made, though, I guess. So.
And lost. Everybody that's only
Yeah,
made up
made
for
and
the
lost.
trade.
Most definitely. No risk, no return. That's a high risk. That's a high risk industry. High risk investment.
You know, during them times when they had the depression and everything, you used to be looking, running from building to building, looking up. And you know why you used to be looking up?
See you jumping off.
Yeah, you ain't got hit by no falling body. It ain't the rain they're looking for. Okay, beta. All beta measures, it establishes a relationship between the individual stock and market behavior. In other words, they go back and look at trends, how a stock has behaved. Normally, they say, does the stock go up or down when the market in general goes up or down? So if a stock goes up as the market goes up, it has a positive beta. Now, if a stock moves up the same percentage when the market moves up a percentage, say the market goes up 5% and the stock goes up 5%. It has what they call a beta of 0. It equals the movement in the market. Suppose a stock, the market goes up 5% and the stock goes up 7%, then it says it has a beta of 2 in comparison to the market. So every time the market moves 1 1%, it moves too. Okay? If it moved down, then it would have a negative beta. Why would someone buy stocks with negative beta? Well, when in general, like COVID-19, right? The market went down. Stocks with negative betas would have outperformed the market because I'm not saying that they would have gone up, but they would not have gone down as much as the market would have gone down. Does that make sense to you?
Yeah.
So many times they use betas, what they call as hedging. But again, that's way beyond what they're going to cover. But again, going back to the point of just educating and making you aware, that's what I'm trying to do. Key ratios: dividend yield equals the trailing 12-month dividend divided by the stock's price. That's all it is. Earnings per share equals the trailing 12-month net income divided by the total number of issued and outstanding shares. Price to earnings, or PE ratio, equals the price per share divided by the earnings per share. PEG ratio equals the price to earnings ratio divided by the long-term EPS growth rate, earnings per share growth rate. Dividend payout ratio, the percentage of net income paid out in dividends. Okay, we're going to try and get through derivative products and then we're going to call it an evening because I know there's a lot of information.
I'm happy that you know that, sir.
I don't give the example. No, and it's concepts that if you're not familiar with it, at least you guys are familiar with some of the stuff we're talking about because of your banking background. I had classes where I get a whole class full of policemen. And they hardly know what a savings account is. So imagine trying to take them to this level of finance. Derivative products, mutual funds, investment companies. Mutual funds operated by an investment company that raises money from shareholders and invest in its stocks. Open-ended, a type of mutual fund where there are no restrictions on the amount of shares the fund will issue. If demand is high enough, the fund will continue to issue shares no matter how many investors there are. Open-ended funds also buy back shares when investors wish to sell. Open-end funds are generally managed actively and are priced according to their net asset value. Some open-ended funds are more conservative and provide consistent returns with low risk, and some are more aggressive in seeking to make capital gains through constant trading. Closed funds. When an investment company issues a fixed number of shares in an actively managed portfolio of securities, the shares are traded in the market just like common stock. Okay, a lot of information. First of all, the concept of a mutual fund. Mutual funds financial instruments that that were instituted primarily to allow the investors to invest his money over a broader base of funds than he would have been able to do so by himself. Let's just say, if you wanted to buy several stocks, but you have limited investment capital. So if you had to go and do that investment by yourself to buy the stocks that you wanted to buy, you may have bought, the amount you would have bought would have been minimal if you would have been able to buy them at all. However, if you were to find a mutual fund who incorporated these stocks into their portfolio, you would then just have to buy shares of your mutual fund. Does that make sense to you? I'm assuming it does. Open-ended funds, what they're saying with open-ended funds, some funds, based upon the demand, if more people are demanding more and more of the fund shares, they will continue to issue shares, as opposed to a closed-ended fund, which they issue a set of shares and they issue no more shares after that. If you wanted to buy more shares, you would have to go in the marketplace and buy the shares, because mutual fund shares are traded in the marketplace too. The last sentence, close. The shares are traded in the market just like common stock. Advantages of mutual funds: professional investment management, diversification, liquidity, transferability, variety of types of funds, transferability between the funds of a given company. Everything I said. Professional investment management, because they are professionals running the mutual fund. It allows you diversifications. You can buy across a broad number of stocks. Liquidity, you can get out of it. You can sell the shares of the mutual fund whenever you wanted to, either back to the mutual fund owners, or you can trade it in the marketplace. Transferability, what they mean by that is you can transfer the funds, the mutual funds, in terms of I could sell my funds to Richmond. Variety of types of funds. You got equity funds, bond funds, hedge funds, and transferability between the funds of a given company. Meaning, if a fund owns several types of mutual funds, let's just say CIFP own an equity fund and a bond fund, and what they call a global fund. If I said, look here, guys, I want to transfer some of my equity funds into the bond funds, they'll do that because they own the fund. That's what they mean by transferability between the funds of a given company. Disadvantages of mutual funds: unsuitable for short-term investment. This ain't your Christmas saving club type thing. This is a long-term more. Unsuitable as an emergency reserve. The value on it can vary. Well, professional investment management is not infallible. And every day that's true. Not what they have. They have something called exchange traded funds, real estate investment trusts, and hedge funds. These are just more types of funds. Exchange traded funds, a fund that tracks an index so it can be traded. I'll leave you guys to read this because again, those are just you're going to need to know the nuances of all of those. I would say try to understand it. Options. Oh, this like the bear of the market. Remember the example I told you about selling short and buy and so forth? Short selling is an option. Understanding options. The two key types of options are the American option and the European option. The American option allows the owner to exercise at any time before or at expiration, while the European option can only be exercised at expiration. When you buy or sell an option, you have an exercise date. Remember I told Mr. McDonald, I go sell him a share at 9 for settlement on February the 15th. It wasn't the date, I didn't say now, for settlement on February the 15th. That's the exercise date.
Oh.
He can't come ask me for that security before that date. That's the exercise date that we agreed upon. You got that?
Yes, sir.
Call option, an agreement that gives the investor the right, but not the obligation, the right, but not the obligation to buy a stock, bond, commodity, or any other instrument at a specified price within a specified time period. Okay, let's look at this. This is a little bit different from short selling. I think there's a very active market of, they call them call and puts. Call is an option that I would buy if I wanted to reserve the right to buy a stock at some time in the future at a specified price. Okay? But I gotta pay for that option. Let's just say Mr. Ritzman is selling an option to me, what they call a call option. He is giving me the right to buy from him 10 shares of Scotiabank on February the 15th at a price of $10. But in order for me to buy that option, in order for me to get that option, I got to pay him $1 for the option. I got to pay him $1 for that reservation or that reserve or that option. Now let's look at this. So I paid Mr. Ritzman $1. I now have a contract that says I got the right to buy from Mr. Ritzman 10 shares of Scotiabank on February the 15th at a price of $10. 10 shares at $10. Or $10 a share, really. Why would I want to buy that option to buy Scotia at $10 on February the 15th. Why would I want to buy that? Clemia, why would I want to buy that? What would be my rationale for wanting to buy that? Clemmy, that's what they call.
You said, you go over that again, please?
Don't go to sleep in this fast, man.
No.
Why would I want to buy an option that would give me the right to buy Mr. Rithman's 10 shares of Scotiabank on February the 15th at $10 a share? What am I obviously thinking about the share price of Scotiabank?
That is going to increase.
That's correct. Not only that, I think it's going to increase above $10. But in actuality, Mr. Rithman, in order for me to make money, what do I need that share price to increase higher than?
I'm assuming more than the call amount, which is $10, higher than $10.
No, but you're on the right track. I needed to increase more than the. Miss McDonald. Why, Miss McDonald? Tell me how I receive.
And the price is already $10. So even
Right.
even if the price what for the share would have changed to 11, you still wouldn't have made a profit since that's how much you purchased it for, technically. So you needed to go more than 11.
Exactly. Y'all understand the rationale? Y'all understand why I need to come up with $11 because I gotta buy the stock at 10, plus I paid the $1 for the option.
Okay.
I won't be in the money until that stock increases above $11.
Okay, I understand.
Now, with the calls, suppose the price, instead of going to $10, goes to $9. What do you think I can do then?
You could call it at 10. Being that you were protected to a degree based on your option.
I cannot call it a 10. Why would I call it a 10 and the market price is 9? Why would I pay you $10 for it and I could buy it in the market at 9?
In that case, then would you go on to the put option where you can sell it at a specific amount?
No, well, let me tell you, it's quite simple. I'll just let the call option expire. I won't do anything. I'd lose the money that I paid for the option. You understand what I'm saying?
Yes, sir.
I wouldn't do anything. It don't make no sense for me to buy from Mr. Rispman at 10 when I could buy it in the marketplace at 9.
Okay.
Okay. Now they give an example of the call option. Y'all guys, please read that. The put option, because we are at 8:19, I gotta start wrapping up. Put option, an option contract gives the owner the right. Let me go back to the call option and that example that's in the marketplace. Now you understand why I emphasize the call option gives me the right, but not the obligation. I'm not obligated to buy it at 10. I have just reserved the right to buy it at 10 if I so desire at that date.
Yes, sir.
Okay? A put option, an option contract giving the owner the right, but not the obligation. I keep emphasizing this. These options give you the right, but not the obligation to sell a specified amount of an underlying security at a specified price within the specified time period. A put option is just the opposite of a call option. Okay, guys, that's what we're gonna get in tonight. Okay?
Okay.
Oh, God bless you.
There is a sheet in here that has time value, there's key terms and definitions. I suggest you guys pull this sheet and look over it. This is something that you keep at your desk or something, and just make sure you go back on and refresh your memory about the definitions. Okay?
Gotcha.
Which sheet is that?
It's called a definition sheet. It's at the back when they wrap up the time value of money. It's called the time value of money, key terms and definition.
Okay, I see it now.
Okay? Okay, guys, have a pleasant one. Remember now, we've slotted in one more class, February the 3rd. Put it in your calendar. And then you'll have the class beginning with Ms. Archer on February the 4th. So on that week, you'll have two classes, okay? Not
Yes.
with me, but you have two classes in this.
That particular week.
All right, okay?
Okay.
Okay.
All right. Guys, enjoy the remainder of your week till next week. God willing, all y'all be safe.
Yes, sir.
Okay,
All right, take care.
okay.
Bye-bye.